Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
That's right. It's been a bumpy ride in the market the past few weeks. With investors seeing losses and gains, it's hard to know what to expect next. While he can't predict the future, we knew it was time to have a good old return guest back on the pod to help shed some light on what's driving shifts in the market.
Yeah, I think we should call it Story Time with Brad.
It's a great idea. Let's go.
Okay, so we have a guest on today that no longer needs an introduction. He is a multiple time guest on the podcast. We should probably just call him co-host.
Indeed. And it's great. The best part about it is we don't have to prepare. We just like, hey, Brad, and ask questions.
Tell us what we want to talk about, Brad.
Hi, Brad.
Hi. Thanks for having me back.
Yeah, good to see you. Well, I think listeners, our goal always is to maybe do a couple of these each year with Brad. For those that don't remember, Brad's the managing director over at Tectonic Advisors, and they are all things investments along with us. They're a partner in it, and it's super helpful to have them, Brad, Paul, the entire team over there shedding light on things for us. So we'll do a little mid-year update, talk about the markets, what's going on there. But I think, Judson, a good place to start is maybe AI. Everybody's
Never heard of it.
Never heard of it at all. I think that's driven a lot of the narrative this year, Brad, in the markets. Like everybody's chasing that company. Everybody wants to talk about AI. Seemingly it's every time there's a headline, it's something about AI, right?
Yeah, it's really the only thing in the market, kind of. All the investment it's the linchpin for pretty much the whole thing right now. Much like .com.
Yeah.
So.
Oh, and I think that's a great segue into, you sent an email around that we wanted to start with. Is pretty fascinating. And it has to do with like fiber optic cable, listeners. And before you go to sleep, Judson's going to start snoring here in a second. It's actually kind of an interesting story. So you've got all the fiber optic cable that was getting laid back in the 1990s. They're estimating the total telecommunication investment was probably in the hundreds of billions of dollars that was wasted. And it basically led to excessive investment, over investment, a lot of stuff from a capacity standpoint. They were way over capacity. And that ultimately was a big reason why, we saw the .com bubble pop, Brad, was sort of all this investment pushing into the market, correct?
Yeah. Before I go on, this isn't I'm poo-pooing AI narrative. It's just when I see parallels like this, it's very important to pay attention to them. But I think it was in 1996, there was this Telecommunications Act that was passed. And between 1996 and when the bubble popped in 2000, there was half $500 billion spent on telco spend. That's about 1.2 trillion today's dollars. And it was all fiber optic cable, network switches and all this. And the narrative was, hey, the demand's there for the internet. It's going to be the next big thing. We have to provide all this infrastructure so people can get it. And if we don't do it, somebody else will, and we'll be put out to pasture. And so you just had, billions and billions and billions of dollars being spent. And by the time the telecommunications bubble popped, only 5% of the fiber optic cable that was actually already in the ground was being utilized. That doesn't even account for how much had been already orders had been placed in excess of that. So to your point, it was somewhere in the neighborhood of $300-400 billion that was just kind of set on fire. And you can kind of draw a parallel to that to data centers today, where you just have, I saw a chart the other day, like data center spend is kind of almost completely matching consumer spending. And up until the last couple of years, consumer spending has been 72% of GDP annually. And so you just think about, so the consumer is not spending, but you have that much money being spent where it's completely offsetting it. And it's just kind of like you kind of sit there and you try to do the math and you're like, where's the return, the ROI on this, right? You're spending all this money, where's the return going to come from? It's somewhere out in the future, but how much future growth are we dragging forward to today by spending all this money?
Yeah. And I think there's another one that was fascinating, not just the one on what was driving GDP, but there was actually a chart that also dropped over the past few weeks that for the first time in history, the value of U.S. data center construction will actually exceed office building construction. this year. There are now $40 billion worth of U.S. data centers under construction, which is a 400% increase in just the next or in the past 3 years. So you have all of this, and again, it's that honestly, to your point, it's the infrastructure we probably need for AI to change the world, which we believe here. We've talked, Judson, on the podcast. It's a lot of that infrastructure that we need, but so much of this investment that's being done by Meta or Nvidia or Google or whoever else it is, it's going to be over capacity, wasted, and it's probably going to end up, a lot of it's going to end up in the garbage.
Yeah. So I guess the question really is that, what do we, or maybe even I should say, what do you or the two of you, on the investment committee, what do you do with this type of data? Because clearly there were telecommunications companies back in the 90s and 2000s that, not only survived this investment, but probably thrived in this investment. So how do you approach the AI space knowing this could be an issue down the line, with open eyes?
Yeah, let me start, and then we'll go to Brad because he'll have something smarter than me, and I don't want him to steal mine.
I think you should start with great question, Judson.
That was a great question. I think the first thing to consider is, we can have all the AI spend, we can have all the data center construction, but ultimately, in order to power all of this, you have to have energy. And there was a McKinsey study done last year that data center energy demand is going to grow from about 5% of power demand, which is today, to over 12% in just the next 4 years. So, I mean, that's a problem. We don't even have the energy anyway. And so the first thing I think you look at is you ask questions about the past, like what happened in the past, which is why we're bringing up the story of fiber optics. And then also, like, can we even meet the energy demand that is necessary in order to drive much of this capacity that's being created? And I think from a macro lens, that's how I view it in the next 5 years, which certainly gives me some pause about how quickly AI can actually take, even though we know we need it. Brad, what about you?
Yeah, I think the way to approach it and how we're doing so in our portfolios is to be cognizant of valuation and cognizant of kind of where you are in a cycle, and not to fall into traps of kind of euphoric peaks in the market. And really you just have to kind of have an honest conversation with yourself. Nvidia is a $4 trillion company. Do we think it can be an $8 trillion company? Stranger things have happened. My bet would probably be no. It's already 4% of global GDP. So is it going to be 8% of global GDP? I don't know how you get there. So you have to start having those conversations. And so when we're investing and when we're talking to our managers, they're investing in companies that are doing AI research and are investing in AI, but also have other business units, also have other revenue streams that are not specifically only tied to that. And I think that's what you saw in .com, is you saw the companies that survived, the Microsofts and Ciscos, while they went down a lot, they had other avenues that were not just infrastructure for the internet spend. And so once all that excess capacity got worked through, they were the clear leaders in it because they were able to work through it. And there's companies in the AI space. I think Google's a great example of this. This is not investment advice for people, but Google has search, they have Waymo, they have YouTube, they have all this other stuff that can feed into their AI research, but it's also a standalone business that's profitable. And so if you have an AI glut or an AI, you have to go through the desert a little bit, Google's going to be around. They're not going to go away. And I just think with any new technology cycle, you saw this with the internet, prior to that, you've seen it with many other things, there becomes a disconnect between where you're going and the journey to get there. And the market tends to price things like the journey doesn't matter. And you get way too high valuations too early. And this just happens over and over. And I just think that's what's happening now. I think AI is going to be transformative. It's going to be the internet on steroids, frankly. But is that next year? If you go to Silicon Valley today, they all tell it to be by Christmas, right? And it's the farther you get away from Silicon Valley, that gets getting pushed farther and further out in the future. The loudest voices are the ones talking their own book right now. I just think that we're going to get there. It's just going to be a little bit of a more circuitous journey. And, you're paying up as if it's going to happen next year. And I just think to Hunter's point with energy, and just the amount of capital that's being dumped in without any clear path to a return to investors, you're just going to have to go through a period where some of this is going to be excessive and it's going to have to be worked through.
Man, that was a great question, Judson.
You're welcome.
You're
welcome, listeners.
Yeah, you're here for the Well, and I think it's a good segue on to your point about the question of like what we actually do with it is to maybe look at current markets, because markets are obviously responding to all the euphoria. And I mean, a great example of that would be Google's up 5% this year, Nvidia's up 28%, right? And I mean, those probably don't make sense in the grand scheme of things. But let's go to the market, and I'm going to throw some stuff out there, guys, and we'll kind of get Brad's opinion on what's going on. So I just pulled it through today. Market was off a touch today, but through today, listeners, year to date, S&P's up 8.5%. Now that's the market cap weighted, so the equal weight's up 6.2, just a little bit under, not too big difference there. Dow's up 5.5, and the Qs, Nasdaq are up 9.5. So they're all U.S. equity markets, large cap space, somewhere between 5.5 and 9.5. International, Judson, as we've talked about extensively, up 22% year to date, which is just killing it. Small caps are flat for the year. They're actually down about 0.1%, but I suspect Brad's going to talk about this when we talk about Fed cuts here in a bit. Over the last 3 months, small caps have ripped 9.5% just in the last 3 months. So even though they're flat for the year, ripping here in the short term. Bonds are up about 2%, and then good old Bitcoin at 19 and gold at 25. Okay, a lot of things are up. Some are up more than others. Brad, high level thoughts on like what's going on in the market right now? What's happened these first 7.5 months?
I think high level, okay, under the surface of the market, I think you're starting to see the consumer struggle a little bit. And if you can look at number of any number of metrics, credit card debt, rising student loan delinquencies, rising auto loan delinquencies. So the consumer that's been the main driver of the economy, I think just in general, the average consumer is just tapped out. And you have, while inflation has cooled a little bit and has stayed sticky and it has certainly not rising as fast as it has been, if you do any of the grocery shopping at your house and you go to buy like something like beef, it's up a lot. Okay. So there's that running through the economy. And then you have this tariff stuff that's had the can kicked down the road, and you're going to start to see a little bit of creep in prices off that. So I think that's why you have kind of a disconnect, and you've had a very bumpy market. And you saw it, Walmart missed on the bottom line today. That's pretty rare for them to do. They normally hit their profit targets. I just think that the consumer is just on the struggle bus. And so that's just going to lead into a volatile fall, and you're going to see third quarter earnings be a little bit more volatile than maybe second quarter. And one of the things that happened this year that really has helped the market in these summer months is that when the Liberation Day happened, all these analysts just jacked their earnings estimates down because they were like, we don't know what this is going to look like. The companies weren't giving good guidance. So they were like estimating this is what the impact's going to be. And so I think 80% of companies have beat their earnings. That's good, and revenues have been good, but it's a lower bar, right? The bar got lowered a lot. So of course, if the tariffs didn't kick in, they were all going to smoke their earnings. And so I think that's why you've had like a tremendous earnings season, but the market hasn't like shot up over the summer. I think it's just because everybody's just kind of waiting because that can's been kicked. So I just think August through October always seem to be kind of rough for the market. August has started out super bumpy. I just think that's probably what we're going to have to work through. And then we have a pretty important Fed meeting coming up. That should help. But Jackson Hole's actually tomorrow, so we'll hear Powell speak tomorrow. But I think that September Fed meeting is important. And then once you get through that and the market digests that, I think it'll set it up for a nice end of the year, potentially. Generally, when the market's up, 8-9%, you tend to get higher than that at the end of the year statistically. So I'm not sitting here saying we're going to have a bear market the rest of the year. I'm just saying I think these next couple months are going to, if you're staring at it every day, you're going to pull your hair out.
So what about international? I mean, we've been talking about it on here all year about how it's ripping. And it's good to have in portfolios for a lot of reasons, but this is certainly one of them. I mean, it's up 22% for the year. I mean, kind of what are y'all thinking over at Tectonic that looks like maybe next 6, 9, 12 months?
I think the international stuff's got some legs for two main reasons. One, it's underperformed the U.S. for 7, 8 years. And so if you look at relative valuation, it makes a lot more sense valuation wise. If you pick a company in the U.S. and you pick a a European conglomerate that kind of does something similar, you're going to have a pretty wide valuation discount there on the European side. So if you take a company like a Nabisco and start comparing them to like Pepsi or something, you get basically the same kind of business, but you get it at a discount. And then you've also had the dollar weakening tremendously, which is going to help international. So if you get any mean reversion in the dollar toward the upside, then U.S. markets will catch up. But I do think that international, just being that it's been so out of favor and there's a lot of value there, it's going to be something that we're going to continue to keep an eye on. We're actually bringing some new international managers to the IC in September. We've had mostly indexed, but we think now is a good time to switch to some active management there.
So if you guys were going to pick a favorite Nabisco product, why is it not the Nilla wafer?
I was going to say Nilla wafer, hands down.
Yeah.
And because it goes in banana pudding.
It's the GOAT.
Yeah, it is so good. Okay. What about the
Name
10-year
another Nabisco product.
What about the 10-year yield, Brad? What's going on there? We've talked about that on the pod too throughout this year, and sort of how it's being impacted by rates, or what expectations are, I should say.
So I think since last time I was on here, the good news is the 10-year yield's been pretty range bound. Now it is much more volatile day to day than I'm used to as somebody that looks at it every day. But I think it's right around 4.3%, call it today. But we've been in this corridor between 4.25% and 4.45% now for a good, pretty much since the end of May, which is good because the tariff stuff really caused a big spike in that, and that was getting very concerning. All of our bond managers have some form of a curve steepener on. So what that means is that they're betting short rates are going to come up lower, and longer rates, we're going to get a curve steepen. So you're going to have longer rates stay where they are, move higher. And I think there's a variety of different factors. You have the persistent inflation. We're kind of in a mini stagflation environment here. The Fed looks like they are going to cut. And then you have, just the general indebtedness of the U.S. that's going to keep rates a little bit more elevated. But I do think it is a good sign that we haven't seen that drift higher in the 10-year that we were seeing in April and certainly in May that was getting very concerning. So bonds have been okay here for a while, and we don't seem to have any sort of like credit problem that I can perceive on the horizon that could kind of throw a wrench in the spokes, which is also a good sign for credit markets.
Famous last words.
Yeah.
It always, we say that and then something happens. Judson, do you have something that you'd like to share before we move on?
We failed our listeners.
We didn't. I think I know where you're going with this, but we didn't.
We failed our listeners because while the Nilla wafer is great, it is not the greatest Nabisco product by quite a large margin.
Are you going to do the Oreo?
Is it going
to say the Oreo?
I was going to say the Oreo.
Yeah.
No, but I think the Oreo is good, but I'm not a milk guy really. So because the Oreo in the milk.
I mean, the Oreo in the milk. But
I guess we put the Nilla wafer in the pudding.
I mean, the reality is that the cookies and cream ice cream is the best ice cream on the planet. Like if you're just boiling it down and you have to pick one ice cream, cookies and cream is supreme.
So for the listeners that are not from Texas, our only ice cream flavor that matters in Texas is Bluebell, and they make a cookie two-step, which is cookies and cream and chocolate cookie dough, which is fire.
When you're down here in Texas visiting, if you are from an area that doesn't have Bluebell ice cream, do yourself a favor and just go get some Bluebell ice cream, and you will not regret it.
Yeah.
I have come up with our next top 5, bottom 5.
Absolutely.
Ice cream flavors?
I'm in.
Okay.
I will say also the mint Oreos, underrated.
Yeah. Well, it's still the Nilla wafer.
Yeah.
No, it's good. Okay. Last thing before we get to Fed cuts, and this may be a good segue. What the heck is going on with gold? 25%. It obviously had a great year to finish last year as well. What's going on there? What can you shed light on for the listeners?
I think, in my opinion, depending on what nook and cranny of the internet that you find yourself in, you'll get a wide variety of answers here. But mine is pretty simple. The dollar's devalued 20% in the last, 12 months. And while Bitcoin was kind of the gold proxy there for a while, the reality is most European countries and Asian countries buy gold and not Bitcoin. And so that's what I think it is. It's just it's a dollar hedge because we're on the dollar standard. And so that's why you've seen gold kind of have a resurgence here.
How the gold bar's doing under your bed, Judson?
They're doing great. You can't know my address because I have tons of them underneath my bed.
I always prefer gold because when the zombies come, you can throw the gold bar. You can't throw Bitcoin.
It's a good point.
Yeah.
It's a very good point.
Yeah, I've never thought about that. Okay, let's do Fed. You
Yep.
want to do Fed? I mean, again, you
We
talked
mentioned it
about
already.
yeah, you talked about September meetings coming up. We've got Jackson Hole to your point as well. Small caps have ripped 9.5 over the last 3 months. So maybe because we've talked at length about how interest rates are one of the primary sort of headwinds against small caps. And so when those come down, that certainly benefits them since they do so much on credit. I know you've been talking with our managers behind the scenes on sort of expectations. I don't remember what was our over under 2.5 cuts for the year. I think that was
It
the
may have
over under.
been.
I think we both took
Under.
the over.
Do you think we took the over?
I think
back
so. Regardless, we'll cover that on the end of the year probably. But Brad, from what you've heard, from what you guys are thinking, what are we thinking cuts will look like the rest of the year?
I had our largest fixed income manager, PIMCO, in the office. It was either last week or the week before. They all run together. It was last week because it was right after the CPI data came out. And they said after that CPI print, that internally their odds of a September cut from the Fed went to 100%. And you have to remember PIMCO, Ben Bernanke and Alan Greenspan are on their advisory board. So
What do they know?
Yeah, I mean,
Is Alexander Hamilton?
no,
Oh.
they get a pretty good idea of how the Fed's going to react to certain data because they have the guys that were in the chair for 2.5 decades telling them what they're going to do. So they think we are going to that CPI print was good enough because this CPI print, it didn't fall a lot, but if you look through it, a lot of the stuff the Fed likes to look through came down. Really, what kept it elevated was services and that's highly economically sensitive. So they were able they're going to be able to look at that and feel comfortable cutting. It's probably going to be only a quarter point. And so that will tee up them being able to maybe do one more at probably their December meeting because you still have this tariff stuff kind of lingering. We're going to start to see that creep here over the next couple months. So they're going to leave themselves some wiggle room there. They're not going to do anything dramatic. I know they're getting a lot of political pressure and all that, but I do think the Fed's in a really tough spot, and I do think they're being very, very careful. As I mentioned on my weekly calls, I got a really good question from a client, and I was like, why can't the Fed just cut and then if inflation goes back, just raise again? And the answer is because when the Fed cuts, the short end of the curve adjusts immediately, but it takes 12 to 18 months for that cut to work its way into the real economy and start affecting everybody. So like if the Fed cuts a quarter point, if you have floating rate debt, it doesn't reset lower tomorrow. It resets lower next quarter. And then your next payment is so that's just one little micro example. And so if you think about it like throwing a rock in a pond and you have these ripples and they're pretty uniform and it looks calm and then it settles down. Well, if you throw a rock in the pond and then immediately throw another rock in the pond, it gets really chaotic really quick. So if you cut rates and then 6 months later raise them, now you have all the after effects of the raise coming on the tail end of the cut. And the banks stop lending. Everybody kind of, puts their head in the sand and kind of waits. And it just immediately kind of shuts everybody's water off for the economy. So that's why they don't do that kind of stuff. They're deliberate.
Yeah, and I would suspect, the market, I think, given what Kalshi's saying and many economists at this point are saying about a cut coming, I would assume the market is almost somewhat pricing it in, which is another factor that puts the Fed in a really tight spot because if they don't do something, it could, do a little temporary shock too to the market.
Last time I checked the Fed Fund futures, they've priced in 2. So if we do not get one in September, market's going to get messy. Now, the market may start looking pretty good if the Fed cuts and then changes some of their language to say, hey, we're going to be able to do some more of this. I don't think you're going to get that at the September one, potentially in December.
Okay. Final answer from Storytime with Brad. Maybe 2 cuts this fall. And again, we'll have him, listeners, as always, we're going to have him on at the end of the year to sort of cover the full year. And hopefully this was all really good info at times over our head. But you know what's not over our head? Nilla wafers and Oreos.
That's not over our head either. But you've also said a word twice today that I want to bring up. You said the word Segway twice. And so I have 2 questions for you guys. Has there ever been a worse mode of transportation invented than the Segway? And number 2, have you ever seen a chimpanzee riding on a Segway?
I've never been on one, so I don't know what to tell you there.
But they're terrible.
But I have seen a chimpanzee
Riding on a Segway?
No.
Okay. Well, the best way to keep up with this is to subscribe to this podcast that you will never have to miss another episode. You can go back and listen to all the others. If you're enjoying us so far, leave us a review. It will make our day. Seriously. Have a question, comment, or suggestion for a future episode? Drop us a line at camewaters.com/wealth. We really do answer these. And if you want to learn more about what we do when we're not recording these episodes, visit camewaters.com to see how we're helping our over 3,200 clients reach their long-term financial goals.